This is the Financial News Network. I'm Christy Duffy. Travelers companies posted earnings results Tuesday. EPS was a beat at $1.89, above analyst expectations of $1.67. Meanwhile, revenue came in short at $5.23 billion. Consensus was looking for $5.27 billion. And it's important to note that although earnings per share came in above estimates, earnings year over year did drop. Discussing the insurer's financials with us live over the phone, Mark Dwelle of RBC Capital Markets. Thanks for coming on, Mark.
Yeah, my pleasure.
So in addition to what I've just said regarding this quarter's statement, the company's debt-to-capital ratio also rose to nearly 22%, up from last quarter when it was around 20%. Chief Financial Officer Jay Benet says that Travelers is still sitting comfortably. What's your take on the state of the company?
Yeah, I think from their capital position and a debt level position, there's certainly nothing to be concerned about. Their debt-to-total cap level is still comfortably below 25%. Even at 25%, we wouldn't be terribly concerned considering how profitable the company is. They did take advantage of a fairly attractive financing rate during the quarter to pay down some higher interest rate debt and get a little bit of additional capital for going forward.
Okay, and the company said that catastrophe losses for the quarter were $55 million after tax, which was well below the October forecast of $90 million. What was its biggest exposure in the quarter?
Primarily, at that level, there really weren't any that I would call truly large exposures. They did have some impact from the storms that hit the Northeast and the Midwest during December. But apart from that, there wasn't any particular events that you would have said were particularly important in that total.
In another note from the conference call, the company said it had $39.5 billion of exposure to state, local, and revenue-backed bonds. Only $1 billion of that amount is associated with the top 10 highest-risk states. So if muni bonds do in fact have the year that many on Wall Street are projecting, which is not very good, will it be hurt by its holding of muni bonds?
Well, the company has always held a fairly high grade of municipal exposures, and I think the distinction that they're trying to draw in examining their portfolio is they have a relatively smaller portion of exposures that are related to just general obligations or to state-issued obligations. They're far more likely to own particular municipalities related to particular infrastructure or other items where there's a clearer revenue stream in support of the bond. The company's been a big buyer of muni bonds for several decades now. They've generally kind of passed all of the stress tests in the past, and while there are some fairly dire predictions out there, a lot of that seems to already be taken account in the recent movement in muni bond prices. So we don't forecast a significant amount of further pain from here, although it is always possible.
Okay, and what's your outlook on the stock, your price target?
We're in the process of updating our price targets at this point, but our last published report, we have a $63 price target, and we rate the stock and outperform.
Okay, great. Thank you so much, Mark.
My pleasure.
Mark Dwelle of RBC Capital Markets. For further updates and analysis on earnings and more, stay tuned to the Financial News Network. I'm Christy Duffy.